A recent Penn Wharton study said that the federal government will have to dramatically raise taxes within the next 20 years, or we will slide into a death spiral of high interest rates and debt payments from which there would be no deliverance. Former Comptroller General of the federal government, David Walker, said that taxes would have to double by 2030, or we go broke as a nation. So in light of all these dire warnings about an impending increase in taxes, you may be asking yourself, how can you best shield your retirement savings from the impact of those higher taxes? Is it possible to completely remove yourself from the IRS's radar in retirement, or are they always going to be entitled to their fair share? The good news is that when it comes to retirement savings accounts, the federal government typically gives you a choice between paying taxes at the time of contribution or paying taxes on your distribution years down the road. For example, when you contribute to an IRA or 401k, you get a tax deduction on those contributed dollars. So if you make $100,000 and you put $10,000 in your 401k, your new adjusted gross income is $90,000. But when you take distributions in retirement, you will pay taxes. At what rate? At whatever the rates happen to be in the year you take that withdrawal. So if you contribute to a Roth IRA, conversely, you're paying taxes at today's historically low tax rates to avoid having to pay those taxes at a period in time when experts predict tax rates will be dramatically higher than they are today. So if you believe David Walker in the Penn Wharton study, there's a good chance you'll want to be accumulating the lion's share of your retirement savings in tax-free vehicles like Roth IRAs and Roth 401ks. Now notice I said the lion's share of your savings, not all of it. Here's why. When you retire, you will have a standard deduction. If you're married and under 65 and retire today, that standard deduction is $29,200. That means that you could take up to $29,200 from your IRA or 401k without paying any taxes at all. Now I do have one caveat. Any money coming out of tax-deferred investments like IRAs or 401ks counts as provisional income. That's the income the IRS tracks to determine if they are going to tax your Social Security. If as a married couple you have provisional income between $32,000 and $44,000, then up to 50% of your Social Security can become taxable to you at your highest marginal tax bracket. If you have more than $44,000 of provisional income, then up to 85% of your Social Security could become taxable. So as a standard rule, you don't want to have any more than $350,000 in these tax-deferred accounts at retirement as a married couple. If you're single, it's about half that amount. This will ensure that your required minimum distributions in retirement will be less than your standard deduction and low enough that it doesn't cause Social Security taxation. Now, if you already have more than that amount, or you're on pace to have more than that amount by the time you retire, don't lose hope. You can reposition those dollars to tax-free by way of a Roth conversion. You want to execute those Roth conversions slowly enough that you don't rise into a tax bracket that gives you heartburn, but quickly enough that you get all the heavy lifting done before tax rates go up for good. So you do want some money in your IRAs and 401ks because those RMDs can be offset by your standard deduction, but where else should you be saving your retirement dollars? Well, one of my very favorite tax-free investments is the Roth 401k. That allows you to contribute up to $23,000 with an extra $7,500 catch-up if you're over age 50. Same for your spouse. This is one of my favorite tax-free alternatives because most employers give you a company match and can direct that match to the tax-free portion of your 401k. That's free tax-free money. Double win. Also, if as a married couple you make less than $230,000 of modified adjusted gross income in 2024, you and your spouse can contribute $8,000 each to your Roth IRAs for a total of $16,000. Lastly, you may want to consider making contributions to what I refer to in my best-selling book, The Power Zero, as the Life Insurance Retirement Plan, or LIRP. These accounts grow safely and productively and allow for tax-free distributions. But the real allure of the LIRP is that it provides a death benefit that you can receive in advance of your death for the purpose of paying for long-term care. For example, if you have a $400,000 death benefit, they'll send you $100,000 every year for 4 years for the purpose of paying for long-term care. They may discount that $100,000 slightly based on the age in which you received the benefit, but the point is this: they're willing to give you your death benefit in advance of your death for the purpose of paying for long-term care. So here's what a balanced, comprehensive approach to tax-free retirement might look like. You'll have money coming out of a Roth IRA, Roth 401k, Roth conversion, distributions from your IRA up to your standard deduction, your LIRP, and if you can keep your provisional income low enough, then your Social Security is likewise tax-free. And if you have tax-free, 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 and tax-free, what tax bracket does that put you in? That's right, the 0% tax bracket. And why is the 0% tax bracket so powerful? Because if tax rates double, 2 times 0 is still 0. So is it possible to have a 100% tax-free retirement? Well, with a little bit of planning, not only is it possible, but it may be indispensable to you wringing the most after-tax dollars out of your retirement plan. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.